So I don't know.
So I'm turning on the video. You guys will be on live shortly.
Just ask Violet.
She can hear you. And that is the official answer. I don't know.
But it has to be.
Umeshampatia slides? Attend this third webinar presented by PKF, TRA, and Tanzania Association of Freight Forwarders. My name is Mustansir Ghulam Hussain. I'm a managing partner of PKF, a firm that is leading currently in providing audit, tax, and advisory services. This time we've decided to join hands with our friends, Tanzania Revenue Authority and Tanzania Association of Freight Forwarders, taxpayers who are specifically operating in transport, logistics, and clearing sector. So therefore, the presentation today has been geared to address those challenges. And of course, we have experienced presenters from PKF, which is Hussein Kimweri and Judith Fulgens to take us through the special tax challenges. And we also have a special and Mrs. Beatrice, who will take us through some of the salient features of customs. I request everyone to pay a particular attention because this presentation is specifically tailored for you. And we will do a formal part of the presentation for 1.5 hours, and another 30 minutes will be left for people to put in any questions, and that will be answered live. And some of the questions, if we cannot answer during the time frame, PKF will revert back to you with a written response. Thank you very much. Let me ask, as we say, ladies first. So let us ask beautiful lady Judith to take us through the first part of the presentation. Judith, please, comments.
Thank you, Mr. Good afternoon, everyone. My name is Judith Fulgens, a tax analyst at PKF. Today, I'll be talking about, among other matters, key reconciliation tips, issues relating to credit notes, matters regarding errors in the VAT returns, and new restrictions imposed in relation to unrelieved losses. Straight to the presentation, I was discussing earlier with my friend that I came across audit findings which had raised a query in relation to variances that were noted between sales as per EFD, sales as per VAT return. And I believe this is a common query that has been raised by the revenue authorities to many companies. So today I'll give four basic reconciliation tips that can be used in reconciling such variances. First is credit notes. Normally, the EFD does not only record sales invoices that have been raised and does not take into consideration the credit notes that have been raised within the period. So credit notes are a good, one of the major or basic reconciliation tip to look at. Another reconciliation tip is to check if there was an error in issuing the fiscal tax receipts, either if in cases of the amount, instead of indicating the amount, someone indicates the TIN number as the amount. So those are the errors that may result that may lead to such a variance. Another reconciliation tip is looking at the timing issues. When a particular tax receipt that was raised, when was it recorded in the Z report? For example, you may issue a tax receipt today, and then it is captured in the Z report of the subsequent day. So that is another reconciliation tip to look at. The fourth is looking at the time of supply. And for this, I love to give an example of deferred revenues, because for deferred revenues, they are recorded in the books of accounts or in the books of accounts as revenue relating to the subsequent period. While when it comes to VAT, such amount, when it comes to VAT, you have to account for VAT on such amounts. So in case of variances between sales reported in our books and VAT return, Those are the 4 basic reconciliation tips that one can look at, among others. The list that I've given is not exhaustive. There could be other reconciliation tips that can be used. Moving on to credit notes, I have mentioned credit notes while talking about reconciliation tips. Now, we all know credit notes are usually raised by suppliers in case they want to cancel a sale that was initially performed, or in case of a change of supply. But for VAT registered traders, it is very important that these credit notes are supported with adjustment notes that the form can be downloaded from TRA's website and filled correctly. The form, it's very important to know that the form also requires you to stipulate clearly the reason for that particular adjusting event. The key issues to note in cases of adjustment note is that it should be raised within 7 days when the person becomes aware of that adjusting event, and it should be acknowledged and signed by the customer. And it should also, it is very important for both parties to retain the adjustment note. And also after that, after it has been raised, then the customer and the supplier are then allowed to make an upward or a downward adjustment. An upward or a downward adjustment, I'll give an example. In cases where a supplier has cancelled a sale, in such an instance, he will be supposed to do a downward adjustment, and the customer will be allowed to do an upward adjustment. As I've already mentioned, the form is available on the TRA's website. You can download it and see the particulars, and you have to fill the particulars properly. It is very important to submit the adjustment notes together with the credit note and the invoice and the corresponding invoice to TRA prior to doing such adjustments, either upward or downward. That was for the case of now there are instances when the VAT return erroneously filled. Now the law categorizes errors into 2, one being a major error and another one being a major error and another one being a minor error. For cases of minor errors, these are errors. The law defines minor errors as errors that the resultant VAT is less than 100 Tanzanian shillings. Now, for the cases of such errors, a person is allowed to amend the subsequent VAT return. But for cases of major errors, of which these are errors whose resultant VAT is more than 100 T shillings, a person is supposed to make an application to the Commissioner General so that they are able to amend the VAT return. And once the Commissioner General accepts the application, then the person will be allowed to amend the VAT. But I think my fellow panelists can comment on this, that practically what happens is that they make an application to TRA, attach the old VAT return, and then attach also the amended VAT return. And even if there's any evidence to substantiate the error, so that to speed up the process. Moving on, now we have seen that there are errors. Errors are how that a person can keep in place or a company should keep in place to minimize such errors. And one of the control is to ensure that there is a clear Excel copy of all sales, a clear Excel copy of all sales invoices and purchases invoices that have been claimed in the VAT return. And for the case of requires a person to insert the block figure, and therefore it is very important to keep a what has been claimed as sales in each particular period, that is monthly. And for the case of purchases, it is very important to ensure that for every purchase that has been claimed in the VAT return, it has a corresponding fiscalized receipts. Also, it's very important to do reconciliations before submissions of the VAT returns, ensure that there is a well-maintained VAT account, and also make sure that there's a second review before the VAT returns are filed. I think that was enough in cases of errors. Now, I would also like to present a little bit about input tax claiming. Before moving on to input tax claiming, it's very important to know at what particular time are you required to account for VAT. Now, the law has described when earlier of the 3 events happen, then the person is required to account for VAT. One is when the invoice for the supplier has been issued by the supplier. The second one is when the consideration of the supply has been received in whole or in parts. And the third one is at the time of the supply. That is either when goods have been received or service has been rendered. Now, for the case of the first scenario, when the invoice for the supply is issued, then the VAT that a person is supposed to account for is the VAT on the total amount indicated on that particular invoice. For the case of when the consideration for the supply is received either in whole or part, a person is supposed to account for VAT on the consideration, on the amount of consideration that has been received. If it's the whole amount, then on the whole amount. In case of a part amount, then the person is supposed to account for VAT on that part payment that has been received. And in cases of the time of supply, the VAT that a person is supposed to account for the case of goods, the value of goods supplied, and for the case of services, the value of the service that has been rendered. It is very important to know that VAT is not applicable on exact reimbursement and price discount, but I think my fellow colleague will also present in detail about reimbursements. So we will see that in his presentation. But I had prepared two questions. If I was able to see my audience, I would pick two people to help me figure out the answers to these questions. One was how do we, after now having known when to account for VAT, the first question is how would you account for VAT on advance received or advance payment? And I believe that question will fall in my second condition, which I mentioned, that the time when the consideration for the supply is received in whole or in part. Now, in cases when I receive advance, in cases of advance, the person is supposed to account for VAT on that particular advance amount that has either been received or paid. And another question that I have is how do you account for extra reimbursement? I might have not answered this question already and asked Mr. Okege that the mention of reimbursement, he gets to clear out this question. Moving on to input tax claiming, there are requirements. A person is allowed to claim input tax that has been input tax that has been incurred in either the acquisition of goods, services, or removal of property. But the law has placed a restriction on the following items, that even if you incur VAT on the following items, you're not supposed to claim it in the VAT return. First is VAT incurred in the provision of in-kind benefits to employees. Another one is VAT incurred on entertainment, that is the provision of food, VAT that you pay on drinks, beverages. It's not supposed to be claimed in the VAT return. The VAT incurred on clubs and membership rights, for example, gym, or social or sporting clubs. Another one is VAT incurred on a vehicle with less than 16% capacity, including even the spare parts, unless that particular person's business is basically hiring of vehicles. But we should also note that even though VAT on such items is not allowed to be claimed in the VAT return, a person can claim it in the income statement. You're allowed to claim this in your books of accounts, even though you are not allowed to claim this VAT in the VAT return. Also, now we have seen that what is supposed to be claimed in the VAT return and what is not allowed to be claimed in the VAT return. But there are basic things to ensure that there are things to ensure that on the invoices that a person has claimed in the VAT return. Because initially I mentioned that for every purchase that you claim in the VAT return, it's very important to ensure that it has a fiscalized receipts. Now here I am to tell you the characteristics that a claimable tax invoice should have for you to claim that particular invoice in the VAT return. First, it should have the particulars of the supplier, that is the TIN, the BRIN, the name and the address. And if the consideration is more than 100 Ghana cedis, then you should have the particulars of the customer. An item that is usually often overlooked. And you should also have the description and the quantity of the consideration, or entail the description and the quantity, and also the value of the supply together with the VAT that has been charged. But remember, it should also have a serial number and and it should be electronically generated by a physical device. Now, for input tax or for VAT that has been incurred in the acquisition of financial services, for example, bank charges, you can claim it in the VAT return as long as you have a periodic statement, which is usually issued by the bank. But a periodic statement is totally different from a bank statement. So if you have a periodic statement, then you're allowed to claim our VAT incurred maybe on bank charges and any other services or fees that may be charged in the acquisition of financial services. I guess that was enough on input tax. Now, moving on to alternative minimum tax. Alternative minimum tax, it's a tax on corporations with the perpetual and relieved losses of 3 consecutive years. And if a company has losses for 3 consecutive years, AMT, which is alternative minimum tax, will apply on the 3rd year. And at the moment, the prevailing the prevailing rate is 0.5% of the total turnover of that particular corporation. Now, I also have an illustration on turnover on this AMT, which I hope everyone is able to see. Now, you see, this company has losses for 3 years, 2018 to 2020. You should know that in 2018, that was the first year that the company made losses. So if this company has been making losses for 3 years, then AMT will apply on the turnover of the year 2020. And therefore, for that case, this person is supposed to pay 0.5% of the 10 million as it is indicated on my illustration. But then imagine if this particular corporation did not make a loss in this year 2020, then this person would not be liable, or this company would not be liable to pay AMT, because it only applies for a company that makes losses for 3 consecutive years. And what if this company continues to make losses in 2021? Then since AMT applies on a company with 3 consecutive years, then in 2021, it will be the 4th year, and therefore AMT will continue to apply on the turnover of this company's turnover. And therefore, this company will be required to pay AMT even also in the year 2021. But I would also like to highlight on that the issue relating to unrelieved tax losses. The new Finance Act 2020 has imposed restrictions on utilizing tax losses. And therefore, the restriction applies to a company with unrelieved losses for 4 previous consecutive years. And therefore, if a company has losses for 4 previous consecutive years, and in the 5th year, the company has chargeable income, then the law requires that the only loss that should be brought forward, it should be 30% of that person's income. And then the unutilized tax loss will be carried forward to the subsequent year. I believe this is very much understood if you have an illustration. And as you can see, there's an illustration that I managed to put together. This company has unrelieved losses from 4 previous years, which are 300,000. But then in the 5th year, which is 2020, the person has a chargeable income of 100,000 shillings. So for this case, the person is supposed to restrict the losses, because the law has required for a corporation with unrelieved losses for 4 previous years is supposed to restrict the losses. And in such case, in the year 2020 will be 30% taxable income, which is going to be 30,000. And therefore, the taxable income that will be remain subjected to income tax will be 70,000. And the rest of the loss that has not been utilized in this particular year will be carried forward to the subsequent year. And for this case, or for this example, will be 270. And conclusively, I would like to just highlight on basic items regarding to withholding tax. You see, withholding tax is a tax which is applicable on payments that have a source in the United Republic, but is also applicable if the activity was carried out in the United Republic, or if the activity the place of payment, even if it was paid, the payment was paid outside the country, but then the payment has a source in the United Republic, or the person or the activity was carried out in Tanzania, then withholding tax will be applicable. And the law has clearly given a very wide definition of what payments contains, whereby payment is defined as a transfer of assets, money, could be a decrease in liability or a creation of an asset in another person. In that case, or use or availability of asset or money. And for the case of withholding tax, it is categorized into two: final tax and withholding tax. And for final tax, it includes like dividends or interest paid by resident financial institutions. And for non-final tax, includes royalties, withholding tax paid. It includes royalties, withholding tax paid on provisional permits, rent, interest paid to non-resident financial institutions or related party entities. I also had on my slides, I put together some of the basic rates, withholding tax rates that I'm not going to be able to read out. But once these slides are shared, you're able to see some of the basic withholding tax rates that apply. And the list that I put up is not exhaustive. It does not contain all the withholding tax rates. But then these are some of the basic withholding tax rates that are applicable. And also I highlighted on items that have been excluded from the withholding tax as per the practice notes of 2013. And one of them is a payment of transport services, except the commissions and fees thereon. Service fees that are charged by a financial institution have been exempted from withholding tax, excluded from withholding tax. Payments to government relating to their statutory performance. And also I've highlighted other items that have been excluded from withholding tax. And because of time, I will just conclude by highlighting on the major withholding tax risk items that I would really love for everyone to take into note. First, withholding tax is due upon payment, and payment is just not in terms of giving out money, but then you should also take note that the law has given a wide description of what payment entails. And I also had a little illustration of what would be the withholding tax base in form of the question. The first question was, is VAT included in the withholding tax base? And the answer to that is no. Are disbursements included? No, disbursements are not included, and we will see a detailed presentation on this matter. And the other third question is, what if an invoice splits between materials and the service element? Then for such cases, withholding tax will apply only on the service element. And it is very important. It's very important that a person maintains a withholding tax account, and also they avoid net of tax contracts, because even the law does not support such contracts, and they're very unfriendly arrangements. I would like to end my presentation here and would like to invite Mr. Hussein to proceed with the presentation.
Thank you, Judith, for your excellent presentation. And I know you have covered one of the very basic, one of the very important areas of VAT EFD reconciliation, which many of the clients do get it. They tend to overlook, because once they submit VAT returns, then they forget that there is some number that is reading in EFD. And very many of the times I've seen TRA the first when they try to do the audit, the first thing they do is to check the recon between VAT and EFD. So we request all the viewers who are taking part in this webinar to ensure that when your VAT return is submitted, make sure your accountant do check the VAT returns, the numbers that you reflect in the VAT returns and the number that you reflect in EFD. And that has to be reconciled. And immediately, some of the tips that Judith gave you will immediately come in handy. Maybe we'll take more questions during the Q&A. Maybe we'll ask Hussein to take us through the second part of the presentation.
Hi, everyone. My name is Hussein Kimweri, tax manager from PKF. I'll be with you to discuss the issues relating to VAT, especially very risky VAT items. One of the very riskiest item is bad debt. We know the bad debt is really bad. bad. That's why it's been called a bad debt. There is no good debt at all. So having a bad debt in today's business is a normal thing, because more than 90% of the today's business in the world are being conducted on credit basis. In few instances whereby there's some few companies are trading based on cash basis. So long as you are trading based on a credit basis, bad debts are inevitable. So in our tax laws in Tanzania, yes, the laws have recognized, yes, there is a possibility of a business person to have these bad debts, because we get ups and downs in the business. So it's not always the case that you can be able to collect the money from your customers. So let's see how does income tax and VAT treat these bad debts. So of course, both laws, income tax and VAT, have established the criteria to be taken into consideration into providing the allowances for these bad debts in case they have occurred. Because without having these restrictions, we have some unfaithful traders or business person which can use this bad debt or can take advantage of bad debts to erode the taxable profit of the income. So let's start with income tax. Of course, we have major criteria that in order for a person to have been provided with allowance for bad debt, that person should satisfy himself that all reasonable steps has been taken and the person reasonably believes that the entertainment or claim will not be satisfied. So this is simply that a person should take all reasonable steps to ensure that this money has been collected. But then at the end of the day, it proven failure. So this is the major criteria which has been put under income tax. But then for the VAT perspective, of course, that one from income tax, the one among the factors or the condition to be included when giving allowance for VAT, for bad debts for VAT perspective. But again, for VAT, we have another condition that a debt should remain unpaid for at least 18 months, and the debt written off as a bad debt in the account. So in the VAT perspective, we have additional requirement. Instead of a person to have all taken these reasonable steps, but as well that person is required to ensure that this debt has remained unpaid for at least 18 months. Now, we have the most practical challenge to address these bad debts for both laws, income tax and VAT, because the law addresses that a person should have taken all reasonable steps. Now, what is really reasonable steps mean? There is no definition in the both acts, whether in income tax or VAT, the definition of reasonable steps. Now, it depends on the personal judgment, what really reasonable steps are. For instance, a person can be just sending emails day and night. These are just reminders for the to customers to pay back the money, the owed money. Or a person can have making a calls frequently to remind the customers to pay back their money. But still, this can be judged by this person itself that this is a reasonable step. But then our friends from TRA, they mostly rely on the legal recovery procedures. These are the only items to be considered as a reasonable steps, legal recovery measures. But then sometimes when you look at economic impact, it may not be economical because you have a debt or unpaid money and you are sure that this money is not going to be paid at all. But at the same time, you have to incur another cost to execute these legal recovery measures. So at some point from the customer side or taxpayer, it might not be seem to be economical. So these are the practical challenges for bad debts for both income tax and VAT perspective. Now, from VAT perspective now, what are the remedies or the adjustment allowed for bad debt? Okay, For the case of VAT, suppose those measures has been taken in reasonable steps, and then the debt is still remain uncoverable. So this person is allowed to make a decreasing adjustment in the VAT returns just to make sure that the money has not been lost for VAT purpose. Because at the end, at the first, when this customer has raised an invoice on a credit basis, as my fellow Judith has presented under section 15 of VAT Act, that the earlier of three, one of them was when the invoice is raised, you need to account for VAT. So this account has already been, this VAT has already been accounted for in the VAT returns. But at the end of the day, this VAT has not been collected. So the law, for instance, VAT allows for the adjustment, which is a decreasing adjustment. Now let us see the issues relating to disbursement. We have ideally two types of disbursement. We have exact or actual disbursement, and we have disbursement which are not actual. So over here today, we are going to base or to focus on exact disbursement as far as these transport and clearing forwarding are concerned. So the simple example of exact disbursement is just paying the custom duties and other taxes on behalf of the customer and claiming it back from the customer. Now, but let's see the common mistakes which are overlooked by the businessmen in accounting for this disbursement. First, most of these taxpayers or the people who are dealing with clearing and forwarding are not using a disbursement note or debit note as supporting document for this exact disbursement, because the law says if you have exact disbursement, that one supposed not to be charged with VAT because there is no sale that you have been made. So, but then if you are incurring the exact disbursement, VAT should not be there. So the first question which will be imposed by TRA, you need to support these are really exact disbursement, which TRA should not charge VAT on that. So most of them are not using, are not issuing this disbursement note as a supporting document for exact disbursement. Other common mistake is claiming input VAT on items which are not your cost. You as an agent, clearing and forwarding, as I said, you have incurred some expenses, but on the behalf of your client. For instance, you have procured transport charges, and the transporter has charged VAT on that supply. So that VAT should not be claimed by you, an agent, because you are not the final consumer of that service. You are just an agent. So this is just one of the common errors which have been done by the clearing and forwarding agents. Then indicating the disbursement in the P&L and also issuing EFD receipt for disbursement. As I said, debit notes are not invoices, and even the exact disbursement are not sale. So you are not required to issue EFD receipt or to fiscalize debit note. So this is one of the mistakes that should be taken into consideration. Then let us see the auxiliary services, because we have seen we have ups and downs regarding to these auxiliary services. At the first time, these were zero rated. Then it comes a time whereby TRA has introduced the VAT on these auxiliary services. But now there is no VAT again on imported services, on auxiliary services. So let's see the requirement for auxiliary service to be zero rated. First, it should be an integral part of the supply of an international transport services. So if the main supply is for international purpose, now the services which are connected to that supply is regarding to be auxiliary service, which should also not be charged with VAT. So this is all about auxiliary services. Now let us see the refunds. We have two types of VAT refunds. We have one type of having a refund without carrying forward. That means cash refunds. And the person can have an option to carry forward the negative amount till this amount get exhausted. So starting with carrying forward the negative amount. This is dealing with utilizing the net VAT negative amount to be carried forward from the tax period against the VAT payable until this amount gets utilized to zero. And then we have a refund without carrying forward. So this is the most this is most important area to have a concentration on it. Because refund without carrying forward, it means now you are going to apply or you are going to seek for cash refund from Revenue Authority. Now the law has established these some conditions to be met for the person to qualify for refund without carrying forward. That means cash refunds. First of all, the person has to have negative net amount for the 6 or more tax periods. It means the person should have VAT credit for the 6 months consecutively. Then 50% or more of the person turnover should be relating to make the zero rated supplies, which are so if a person has more than 50% of the turnover relating to export, this person is qualifying for seeking the refund without carrying forward, that is cash refund. Then as well, 50% of the person's input tax should be incurred on acquisition or imports which are related to make the Commissioner General, when it is satisfied that this person is regularly result into negative net amount, then the Commissioner can even allow this person to have an access to seek for a cash refund. Then, application for a refund should be made in writing. And also, if a person is qualifying for a cash refund, also the law is not strict that this person should apply for a cash refund. A person has an option whether to apply for cash refunds or to decide to utilize that refunds until these refunds get to zero. So let's see the time restriction for application for these refunds. The laws provide for 3 years for seeking for a refunds. And these 3 years should be counted after the end of tax period to which the negative amount relate. So if a person have VAT credits for more than 3 years, the person should now start to see when the 3 years start to be counted for, so that the person should ensure himself that he is not being time barred for applying for this cash refund. Then the process of applying for a cash refund is normally trigger the TRA audits, because it's logic that if you are owing a lot of money from TRA as a VAT refund, it's not possible for TRA now to just give you a refund without having satisfied themselves that you really deserve to be to have this refund position. So we have another type of refund, which is a refund for overpayment. This does not relate to either one of the previous two refunds. This happens whereby the VAT paid is more than what is indicated in the VAT return by mistake. Because you can have, let's say, a VAT payable, 1 million shillings in your VAT returns, but mistakenly you have paid more than 1 million, what is indicated in the VAT returns. So for that case, you are even required to apply for a refund for the VAT overpaid. And the timing for request for this type of refund as well is time limit is 3 years. So these are the manner for lodging the application for VAT refund. That application should be made using the form ITX 26202E, and this form can even be downloaded from the TRA website. Then this refund application should be accompanied by certificate of genuineness, which is provided. This certificate of genuineness is provided by the auditor and the person who is registered as a tax consultant as well. Then containing the VAT refunds and have even a checklist for applicants' VAT repayment. Now let us see the most important areas, which is TRA audits and the process. So first of all, we need to let you know about your rights as a taxpayer in the TRA audits. First of all, you need to be informed well in advance before the audit starts so that one can be well prepared. then the taxpayer has a right to identify the TRA auditors, even by asking their identity. Also, a taxpayer have a right to appoint a tax consultant, and the taxpayer is allowed to bring along the interpreters during the interview or discussion with TRA if that person is not well conversant with English or Swahili. Also, a person is given a good 14 days to respond to tax findings. But in our experience recently, our friends, we have been seeing that they've only provided days to respond, but as per the law, you are provided with 14 days to respond to the audit findings. But then not only 14 days, if you feel like 14 days is not even enough for you, because we have seen that TRA are nowadays auditing for more than 5 years back. So responding those findings within 14 days may not be enough for you. So the law is not fixed. So you are even allowed to make for application of extension of the time. So these are just a few taxpayer rights in TRA audits. But then let us see how keeping document is important. As we supported by complete trail of the document or supporting documents. So mostly in our experience that TRA audits may even take 3 months just audit. So most of these audits takes longer time because we have not a tendency of keeping the documents properly. If these documents are keeping properly, so these audits may not take this longer. Also, it is important to keep the documents not only for tax purpose, but then even for the purpose of structured controls and the reporting system internally. And also it may even helps in legal matters, especially contract disputes. So it is very important to have those documents in a place. Even if the laws provide for a person or a taxpayer can have or can keep the documents for good 5 years, but then it happens in other circumstances whereby the TRA can go beyond the 5 years. It may take even more than 5 years, 6, 7 years. So it's better, we advise you to keep the documents properly longer than 5 years, as much as you can. It's better to keep those documents for longer than 5 years. Then let us see our experience during the TRA audit, because we have seen that in some time whereby TRA were only focusing on P&L items. They just scrutinize your revenue, your cost of sale, your administrative expenses, and then to arrive at a profit. But nowadays, in our experience, TRA have not only be focusing on P&L items, but then they have extended their coverage up to balance sheet items. For instance, they are even scrutinizing the movement of intercompany balances, the evidence of loan existence, because a person can report a books of accounts, but then there is no any supporting documents for the loans. The loans cannot be supported either by a loan agreement or by even a bank statement. The person just report from nowhere, this is a loan. So if that is the case, TRA has a right even to treat it as an income and charge VAT and corporate tax on it. So evidence of loan existence, sometimes they request, then test on cash and bank balances. Sometimes they do a verification of fixed asset to see if you are properly claiming for this depreciation allowance. Also, they do the reconciliation for trade receivable and payables against the sales and purchases of your company. So they do, or they go extra miles. We have always seen that TRA are just focusing on P&L items, but nowadays they even focus on balance sheet items. So you should be careful as well. Also, we have seen that the TRA nowadays are not only relying on financial statements checks. Sometimes they even go to third parties to request for the documents, for the information, such as banks can go to your suppliers, your customers, just to seek or to satisfy themselves that the information that has been presented in the financial statements are correct. Then we have the issues relating to transfer pricing policy, which is a very hot item in nowadays, because the law says if a person has a related party transaction worth of 10 billion during the year, this person is mandatory required to submit the TP policy to the commissioner alongside at the time when submitting the return of income. So this also should be the part of submission item. But then if a person does not have 10 billion intercompany balances, this person should also as well stay standby, because at any time in the commissioner can request for TP policy just to satisfy that this intercompany balances has been properly valued in the books of accounts. So we have remedies if a person does not have a TP policy. The Act says clearly that the person is liable for a penalty of 52.5 million as a penalty. Also, we have a tendency of having long-term or long balance sitting as a related party transactions, long outstanding liabilities. So nowadays, TRA are going to treat this as the loans. So they compute interest on such loan because they deem to have been treated as a loan, because in normal circumstances, you cannot have a loan balance for more than a year with no movement, no repayment. So the TRA normally consider them as the loans, and they have a right to charge even interest on that amount of loan, even though it's not direct a loan, but it might be a loan in form of goods. Your related party can just do a procurement of goods on your behalf, then you should pay back your related party. Also, we have a purchase or sale value adjustment between related party. Almost all type of taxes include corporate tax and VAT. So this means if a person has reported the related party transaction balances, the person has failed to prove the validity of these transactions, TRA are even allowed to make adjustment for all taxes, corporate and VAT. So these are the main importance of other items to be considered during, after, and even before TRA audit. So this marks the end of my presentation. Let me hand back my mic to Mustansir.
Thank you, Sen. You have covered one of the very, very hot topics, which is TRA audits. As soon as someone gets a TRA audit, very many times we see a transporter having more than as transport is a very volume-driven business. Your documents, it's not simple business, but it's a very straightforward business. You do transport, you'll have expenses of fuel, you have expenses of drivers, but you come to realize that you have been paying a lot of drivers, there are no records. So yes, majority of the audits are focused on documents. We have done transit cargo, but you don't have documents. You only have invoice that you have done. Transit cargo is zero rated. Now, how do you expect TRA to be satisfied? This was actually transit services that you offered. So yes, documentation part is very, very crucial. And even in our second webinar, we did insist that 80% of the TRA audit is your document keeping. Your accountant is astute enough to ensure that all the documents are kept right, and audit are very, very smooth. Let me ask our friend, Geoffrey, to take us through the customs part of today's presentation. Thank you, Geoffrey. Welcome.
Thank you. Thank you. My name is Godfrey Felician. I'll take you through customs with the matter rated. Okay. Then we start. What we are going to look today is all about customs on cargo clearance and the procedures. It's okay. First, I have my outline, which will be introductions, procedure steps, challenges, and how to overcome all these challenges. First of all, we have to know what is about, when we're talking customs, what is that? The main role of customs is all about the trade supply chain, which involve with the trade facilitation on international trade, collection of revenue, as well on the protection of the society through enforcement of a provision of the law, regulation, restructuring, and prohibitions. Some of other issues is all about customs clearance procedures. These are already, most of the thing is the process of declaration of the cargo, which involve on importation, exportation, and transit. But all these things it have been done through our Tanzania Customs Integrated Systems, which is known as TANSYS. Another thing is let's say when you are making the declaration, or maybe you are supporting, you are dispersing the documents to your clearing and forwarding agent, what is the crucial document must be submitted? These are involved the final invoice, packing list, transport documents, which involves the bill, if it is maritime, airway bill, if it is airway, or cargo notes when it is road or by railway. Another thing is exemption documents, if any, certificate of origin, if you have it, but most of the time you must have the certificate of origin. This is very important to help us to have the statistics for preferential or non-preferential. Another thing is that you must have the export or import permit. If it is regulated, you may find that some other goods, you must have the permit before importing them. And another thing is that you must have the authorization letter from you are the one who have engaged in that business of the clearance, especially from the importer. Another thing, you must have the declaration of the particulars relating to the custom volume. Normally is recorded on the form called Form C41. These are the procedures which you must have to take when you are handling. Let's say you are importer, so you have to submit all the documents to the CFA. Then CFA will seek the permit from other government organization. Let's say maybe we may find that some particular of the goods imported is regulated maybe by Bureau of Standards, TFDA, or Atomic Energy, and some other government related. Another thing, normally we just encouraging our business partner or our importer or CFA to use the things called the pre-arrival declaration process. This pre-arrival declaration process, it is very crucial because normally it helps you to know what will happen before the cargo is going to arrive over here. So normally when you want to do this, especially you have to do this through the agents. So this one normally is done by the CFAs. And another thing is that when the CFA doing all these things, the system will accept the payment notes, and all these procedures, what I'm talking, is all normally done through the TANSYS. These things it have done by, normally it have been done by CFAs. Doing all these things, there are challenges. Normally, these challenges have been done by the CFA that may lead to the offense during the clearance, or maybe it can bring even the delay of the clearance. This common mistakes is long HS code. Sometimes you can find that the proper HS code, which was supposed to be done for, declared for that goods, it has been mistaken done. And another thing is that you can find that there is incomplete attachment, such as BL or parking list, final invoice, sometimes even the certificate of origin. All these at the end of the day, you can find that it is misleading the system. And another thing is the provisional permit. Instead, you can find someone, instead of putting on the provisional permit, or normally we call it a PVOC, that's a pre-export verification of conformity. So someone can try to teach the system. So instead of giving the real value or the real HS code now, someone can put just a blank paper, so that the system, once the system not going that you have already scanned a document over, then the system it's accepting. But at the end of, when our officials opening the document may come to find that, oh, at the end of the day, there is no anything which have been attached on. Another thing is that there is a late submission of the requirement permit. you can find that now the cargo now is have already now arrived at the port, but the final document not yet being submitted to customs. Another thing you can find that there is an incomplete attachment of permit, as I've said, such as a TBS or Atomic, phytosanitary certificate, GCLA, TFSRA, TFSDC, Tanzania Forest Agencies, and some other related issues. Another challenge which we find on this is there is an improper and insufficient description of the goods. This is normally it happens now. Some of the customers who you may find, or maybe some of the CFA, they didn't give the full description. This, if you're giving the full description, this one is going to help our officers who are dealing with those declarations to know maybe the real HS code when they're classifying the goods to be the real value of those items which have been brought. But at the end of the day, if you do all these things improperly, it will result in the delays of the clearance of the goods. Another thing which brings challenge to us, you can find that there is a unreadable attachment. This is normally it happens also. It can make the document to delay. Another thing you can find that there is amendment on packages, or let's say amendment on units of measurements, or amendments on invoices. All these things, if not done as early as possible, it may lead to the delay of the clearance of the goods. Another thing which we found as a challenge to us, there is a multiple lodgement of declaration. You can find that maybe company X or maybe importer Y have imported the goods, but now have already given the document to CFA X. Then at the end of the day, found maybe CFA X have already take out the declaration form and give them the assessment. Found that if the tax maybe is a little bit than what he was expecting now, it just turn aside now, take the same document now, given to another importer Y. So when you are lodging this document, when it reaches to us now, when it goes to the declaration, you can find that BL which is lodged to importer X is the same BL which is lodged to the importer Y. So at the end of the day, you need to cancel that document so that you can lodge afresh. Another thing is that there is an unnecessary delay. That is maybe referring to the direction given by the verification officer. You have been given by the verification officer that the query that, okay, fine, to do this, you have to amend accordingly. Then you say that I cannot do this. So at the end of the day, you find that it will be like dilly-dallying. You have given that what you have to do, just amend first. If you have anything, maybe if you have your reservation, you find again that the challenges is a payment of duty on an amended declaration. Now the declaration now have already amended now. So you were before paid the duty. So what we believe to win. So you cannot say that if I've already now paid the duty, number 3, take it to declaration number 4. No, what you have to do, each declaration is independent. So at the end of the day, you have to pay on this number 4. Then the previous one, you will ask for the refund. And another thing which we have found is that our customer, they have to understand there is issue clearance of the goods under section 16 under the common external tariff, normally under additional note 2. There you can find that we have, let's say, an investor, it can maybe just come to invest maybe in manufacturing or in any production. But what you have to bring here is to bring the machine. So this machine now, normally machine, it can be brought in a documented form. So our section 16 of the set allows to bring this machine in the documented form. But there is a procedure. What you have to do, you have to seek the guidance from commissioners. So you have to write the letter to commissioners asking that, please, sir, Mr. Commissioner, that the CFA are duty bound to ensure the submitted declaration are true and correct. That the submission of incorrect information is punishable according to the, let's say if it is suspicious false invoice, it will be punishable under section 203 of the EAC Custom Management Act 2004. Maybe if it happened that now the clearing forwarding agent can be penalized, as well as section 148 up to section 45 up to 148 of the ESC Customs Management Act of 2004. So how to overcome all these challenges which I have mentioned now? That we are advising those our CFA and the other our stakeholders that they have to make the employment for the professionals, competent and the committed staffs. And not only that, also they have to have the legal update. Also, another thing is fast tracking of the permit from other government, other government departments whom we're working with. Let's say you are bringing your goods, so you have to know if I'm brought these goods, what permit I supposed to have before they clear through the customs. Another thing that, another challenge to us that to overcoming of these challenges, good cooperation during customs clearance process between the TRA officers and the CFA is very crucial. It's very important because maybe it happened that CFA it had been asked, maybe it's not well conversant. So now we are requesting, or we are encouraging this. If it happened that you are not conversant, please visit our help desk, then our guys can. It's all about to overcome all these challenges. It's integrity. Integrity is all we know that integrity is all about the moral issues. These moral issues can be even to our staffs, the TRA. These moral issues can be as well to our CFAs, and not only that, even other government departments whom we are working with. Then, all basing on this, what I've mentioned, now we have other things ongoing with the TRA and the government. So we have these three new projects. This is introduction of Tanzania Electronic Single Window System, which is for this moment is under construction. And another thing which we have in the pipeline is centralized scanning system. That's now, while I'm talking now, is semi-completed, and like the Port of Dar es Salaam is under piloting. And another thing which I've introduced, but now it's already completed since 2020, in the era 2020, is online auction. That's a new project. All these have been done to make a trade, to facilitate the trade, so that this one is going to help to reduce the cost, of doing the business along our country, along landlocked country, whom we are making the service to them. So by the way, when I'm saying single window, is defined as the facility that allows the parties involved in the trade and the transport to lodge standardized information and the documents with a single entry point. This will help in fulfilling all the import, export, transit, and the trade-related regulatory requirements. What is the objective on having this single window? The main objective of this includes that it will reduce over administrative costs associated with the permit fees and the clearance formalities for importing, exporting. Thus, we are expecting it to be reduced by 50%. And another thing is that the objective is to reduce the time taken to obtain all the necessary permits, because all this will be done under single window. And we're expecting these things, if it will go on board, it will reduce all these things, and it will help for export and other things and import by 80%. Another thing is the reduction in the clearance time for imported consignment at the Dar es Salaam port, which we're expecting it will be reduced by 50%. And another thing which we're expecting from this one objective is improving in Tanzania's trading across the border to be ranked from 180 to 150. So now the current status on this, what I've said, that the Tanzania Electronic Single Window, is that now we are in phase 1, that's the customs clearance management, and this covers the import and the export declaration, with the exception of bonded transportation management. So the benefits of Tanzania Electronic Single Windows, as I have mentioned, some of the few that will be saved, time will be saved now, instead of maybe someone, the office maybe it is here and some other it is maybe two kilometers away. Now all of us, all things it will be done on the single window and it will be electronic. And another thing that we will be facilitating the trade. And another thing that will reduce the paperwork instead of using paper, manual work. So this one should be reduced. And not only that, even the increasing glance, how they think is going on is very important. And not only that, even the proper record keeping, reduce the cost of doing business. I have a
for that enlightening presentation. Yes, I'm sure that once we get this Tanzania electronic single window system, I'm sure we will improve substantial efficiencies as far as clearing is concerned. As we say that our port serves more than around 5 countries in East and Central Africa. We will start taking questions, and maybe we will give opportunities to TRA to start helping us to respond to some of the questions. Maybe I'll ask Mr. Malia, my friend, to take the lead and then start, and PKF will come in as and when required.
Thank you, Mr. Mstansiri. Thank you, Mr. Mstansiri, the moderator. The first questions, under which part of the tax laws do we find a mention that the adjustments are to be submitted to TRA? Does TRA keep meticulous records of adjustments received to avoid tax evasion? Would it not be fair for the client to acknowledge the receipt of adjustment notes so that the reversal of input tax can be pinned down to him? Yeah, I think TRA we demand during the tax audit. And I'm sure the person or the officer who is responsible with that audit or examination will take care of the credit, the adjustment notes that will be provided by the taxpayer. And I think that is what is happening at the ground. I think the first question answered. This is a second question. This is directed to TAFFA. Maybe TAFFA.
Maybe TAFFA can. We have also a representative from TAFFA.
Thank you very much. My name is Aditunu Malamia from TAFFA, Executive Secretary. The registration portal for new companies for renewal, because doing manuals is not sufficient for current because there is no time saving. We are working on this. If you can visit our website at taffa.org. A backend and support procedures to allow upload documents and also return of vetted certificate. Thank you very much.
Yeah, question number 3. Have the regulations been amended to conform with the main act, especially in respect of claimability of Vat or general insurance? So far, I cannot be direct to that, but practically, we know that VAT on general insurance, on insurance business, it is covered, and as long the EFD receipts are there, I think it is claimable. And that goes to question number 4. can we include expenses in the VAT form? That is those that are VFD but are related to company expenses, directors' fees. Expenses, if they are the expenses, if you have a genuine EFD receipt and it has been supplied from a but other expenses which are not backed with the EFD receipt, I think the law is very clear on that. Unless you become to claim under income tax as a deductible if you have also proper records. Number 5, are entities required to treat final withholding taxes as non-final withholding taxes in respect of any of the investment incomes, such as interest rate? We know withholding non-final withholding tax is what actually you can deduct from the tax which is has been computed based on the amount of tax that has been computed on chargeable income. But for final withholding tax, I think that is paid once and for all.
Yeah.
Maybe somebody can chip in on that.
No, I think so. Final withholding tax remains as final withholding tax.
Yeah.
Yeah. So non-final can be against your corporate tax, regardless of whether you have investment income or not, as long as it remains a final withholding tax.
Yeah. Question number 60.
Yeah, question number 60, that he says that timely reasonable steps can be more expensive than writing of bad debts. So what is the solution in such cases? So here, so long the reasonable steps are based on judgmental issues. It's a matter of checking the economic situation, whether it's better to write off a bad debt, but if the costs are more than what the bad debt is, I think better to use judgment that is the economic issue is very important to the matter. Maybe my colleague can add on.
Yeah, as it was presented by Mr. Hussein, the question of bad debts is not a sin. But what we want to be assured is that are all efforts to recover that debt failed during that period, during that year of income? So that is the question that you must satisfy yourself. And Mr. Hussein put it very clear that there should be some effort, like letters, corresponding letters, emails. Of course, it came up issue of legal proceedings, which actually it is, as it was pointed by Mr. Hussein, it is going to increase cost again to the person who is having the bad debt. It is a reasonability of the officer to weigh between the efforts that there are general efforts that we can get satisfied that the taxpayer is making all the possible efforts to recover, but the market supply issues. Yeah, my sister also during the presentation, the well-defined minor errors and major errors. Minor errors less than 1 million, you can adjust by yourself without, of course, later on you may give notification to the commissioner, but you can adjust it in the subsequent period. But major ones, you must actually write to the commissioner. And that takes us to question number 8. that if a company made a loss for 4 consecutive years, in the 5th year, the company made tax income, so that so you deduct the loss after reducing 30%. So the 30% loss is lost, so you can claim in the future. In fact, that is not, it is actually taken as non-allowable deductions. You add back during the computation of taxable income. So it is like actually revenue to the government, unless there's someone chips in.
Okay, the question says, if a company made a loss for 4 consecutive years, then in the 5th coming year, it made a taxable income. So do you deduct the loss after deducting 30%? So the 30% loss is lost, or you can claim it in the future. So basically we have 2 questions here. The first one, when should we account for restriction on and relieve the losses? So the person is asking, so do you deduct the loss after reducing 30%? The answer is no. The 30% should not be deducted after the loss. So suppose in our previous example, suppose you have 100 million as a taxable income, then you have 300,000 at the taxable loss. So offsetting the entire amount of loss, the law does not require that, but the law requires you to offset the loss to hit 30% of taxable income, then to regard it as a loss. So that's the first question. Then the second one, it says, so the 30% loss is lost, or you can claim it in the future. Of course, yes, the law says you can just claim your losses until it gets exhausted. So even if the loss have been restricted, so the remaining portion of the loss, you can claim it in the future as well. Yeah.
Thank you, sir. That is a perfect clarification. So that means if you have utilized 30%, if your loss, so that means 270,000, you can still carry it forward. Question number?
Maybe there is some 70% is allowable.
Yeah, so it means
the 30% is the one which is going to be
utilized in the future.
Utilized.
Yeah.
Yes. Okay.
Okay. Question number 9 for VAT amendment. For VAT amendment, what is the process since the VAT is now done online? Is it also done online? Here, it's just the changes is just methodology. We were just doing manually or we're using paper, but here the amendment can be done. The process is the same, but only just methodology has been changed. So maybe my colleague can add more.
Yeah, you are very right that we've just changed the methodology, but other things remain the same.
So can it be done manually?
Communication should continue, but the submission is what is changed from manually to online. Question number 10, suppose VAT return at 0 rated sales declared that were over 1 million based on actuals. I believe we write a letter, but does TRI just the amended VAT return themselves? Or who does this? Who does this? Is there a time frame for this? I think the adjustment is done by the taxpayer himself or herself. And the presenter made it very clear. I think it is clever. My colleague, question number 12, you are saying record keeping is for 5 years, but I know it is now 10 years after the amendment was done. Please clarify this for awareness. I think there's no amendment. We still, the law still, the records are supposed to be kept for 5 years, but it was also presented that you can keep it for a longer period, just in case if they are required, it can be easily retrieved. But 5 years is the maximum. Maybe my fellows.
Yeah, question number 13. Can you elaborate on part that you said if you don't have TP, you can be penalized? Yeah. Here, the transfer price regulation says that it needs for taxpayers to submit transfer price documentation as the presenter said, for those entities or companies having related party worth more than 10 billion, they are supposed to submit the transfer pricing upon submission of a return for income. But for those who are having the related party transactions, they are supposed to keep them so that it's ready when commission needs to submit it. So the penalty is there once you fail to adhere to those laws. Maybe my colleague can add more.
Mr. Hussein, can you chip in?
Yeah, of course, it is clear that the law says if a person has a related party transaction worth of 10 billion or more, that person is mandatory, required. But then for those who have below 10 billion, they have to prepare those TPs, but should be submitted to TRA upon the request from the commissioner. So if you do not have these TPs, whether during the submission, mandatory submission, or upon the request by commissioner, if you do not have them, the fine is 52.5 million penalty. Yeah, that's one is very clear.
Question number 14. If I have been charged transport on behalf of the client supplier, and I charge transport plus VAT to the client, how is that long? The invoice is to my supplier, is to my company. Here, the issue is we have to separate the taxpayers. We identify the taxpayer based on thing or important for the one who has incurred the cost, but the one who has not incurred the cost, you are the one who is not supposed to claim that cost. So here the issue is just to charge the one who is responsible for that transaction. That is clearly that's the issue. Maybe my colleague can add more.
Yeah, thank you. Yeah, I think it is right that that's why when we changed actually we amended the law, the particulars, what particulars should read on the EFD receipt. One of it is the TIN, the name, the declaration, proper declaration, and the amount. So if the EFD receipt is not reading the name of the person who's registered for VAT, I think such a receipt is not clever. You cannot claim.
Okay, thank you, Mr. Malia. I think so. We have reached the last question of our presentation. Today we had only, fortunately enough, we had only got 14 questions. But to rest of the viewers, still, if you have more questions, you have got our email addresses. You can still send us your questions. Our team will be as and when ready to respond to your questions. So for time being, we just want to again extend our appreciation for your time, because it is because of you we have managed to do this webinar. And I can only say asante sana and see you soon. Thank you very much.